One of the biggest challenges that the community told us they have when it comes to investing in our community survey is the idea that the stock market is risky. So we wanted to pull the numbers from one of the books we've written, Don't Stress, Just Invest, to illustrate how the stock market is not risky, especially as you look over a long period of time.
Now, I think we should be very clear and probably also adhere to our licensing conditions and say the stock market
Involves risk.
Can be risky. I think, like with a lot of things in life, it's how you approach it and how you play it. And the stock market can be a casino. You can punt and you can lose all your money. On Monday's episode, we spoke about how companies die and indexes are forever. And one of the stats out of that is that 78% of companies listed between 1950 and 2009 went bankrupt. There is no doubt that there is risk. But when you look at the stock market as a whole, and when you look at investing in an index rather than individual companies, the risk changes. And it walks like a duck and it quacks like a duck. You know, like an index fund and a company both are listed on the stock market. Their prices both move when the market's open. They both have stock tickers. They look and sound and act very similar. But from a risk point of view, they are fundamentally different products. And that becomes clearer and clearer the longer you extend your time horizon.
Well, let's put some numbers to it. So we've pulled the S&P 500 annual growth rate with dividends reinvested for every decade, 10-year increment. And we've also done the same for the Australian All Ordinaries Index, because what we want to show is that if you're looking in 10-year increments, 20-year increments, and 30-year increments, the return profiles and I guess the volatility and risk changes favorably in our view anyway. So if we look at from 1900 to 2010 in 10-year increments, so every 10 years, 1900, 1910, 1920, you get it. The average annual growth varies from between negative 0.6% over a 10-year period all the way up to almost 19%. So huge variance.
Yeah, so if people are getting lost in that explanation, it's like different decades have had wildly different outcomes for investors. And as you said, in the 1950s, the average annual growth rate was 18.7%.
Epic.
So like for that decade for investors, they made money. They made so much money. But then in the 2000s, because of the tech bubble bursting and then 9/11 and then the GFC, it was a shocking decade for investors. And the average annual growth rate was minus 0.6%. So if you look at the market in 10-year increments, the outcomes vary wildly. Things start to change as you zoom out. Over 20 years, there was still some variation. But if we get to 30 years and you look at the US market in 30-year increments, between 1900 and 1930, the average annual growth rate was 9.9%. For the next 30 years, 9%. For the next 30 years, 10.1%. For the next 30 years, 10.1%. Things start to revert to the mean and get very
consistent.
Yeah.
So that's the S&P 500. The story is eerily similar for the Australian All Ordinaries Index. If you're looking at it 10-year increments, it varies from anywhere. Well, it actually does a lot better than the S&P 500.
The Aussie market's been a goer, yeah.
The lowest annual growth rate over the last 100 years has been about 8%. Wow.
No. So it's not the lowest annual growth rate because there's still been shocking years in there.
Yeah. Over a 10-year period.
Over these 10-year periods.
Yeah. And that then comes up to about 18% as well. So for the 30 years from 1900, it was about 13%. For the 30 years from 1930, it was 12%. The next 30 years was about 13%, and then the next 30 was 9%. So again, the volatility, the consistency of it really starts to play out, which is why we stress time and time again the value of being in the market.
Yeah. Now, I know we're throwing a lot of numbers, And the podcast may not be audio. It's hard to convey numbers. And I guess what we say to that is we actually did write it down in a book that's available in all good bookstores. It's called Don't Stress, Just Invest. But I'm going to throw a couple more numbers because we looked at 30-year increments next to each other. We didn't look at overlapping 30-year increments. We looked at 1900 to 1930, then 1930 to 1960. What about... But does this play out in every 30-year window? What if we look at overlapping 30-year windows? So 1900 to 1930, and then 1910 to 1940, 1920 to 1950. So the periods overlap. I've got good news for you, Bryce. It works in every overlapping period, and I'm going to just read the list. So in Australia, starting in 1900, each of these numbers will be one of the overlapping 30-year periods. 13%, 12%, 12%, 12%, 13%, 13%, 13%, 12%, 12%, 9%. Pretty consistent. How about in the US? Let's do the same thing again. So starting in 1900 and going all the way to 2020, each overlapping 30-year period. So starting with 1900 to 1930, then 1910 to 1940. How does it go? 10%, 7%, 8%, 9%, 12%, 11%, 10%, 14%, 11%, 10%. You start to see just how consistent the market has been over the long term.
Yes.
And that's why we say when in doubt, zoom out. That's why we say the magic of compounding takes time. That's why we say think long term. Now, the final wrinkle, Bryce, is inflation. Because the question is, sure, those growth numbers might be great, but does it consistently beat inflation? So let's do the same thing. Let's do these overlapping 30-year periods and ask, does it beat inflation?
So this is adjusted for inflation. We couldn't get inflation data pre-1930 for Australia, so we'll start from the 1930s. So we've got 8%, 8%, 6%, 6%, 5%, 8%, 7% or thereabouts.
Above inflation.
Above inflation. The story in the US is 7%, 5, 7, 7, 8, 7, 5, 8, 7, 7. So yes, consistently beating inflation and consistently consistent.
Yeah. So that's a lot of numbers. We know that. But, we did this work for the book and it's pretty amazing what you pull out when you calculate it. So we wanted to bring it to life as best we could on the podcast because it is just such a reminder why long-term investing is so powerful. And it's such a reminder why people's idea of risk needs to be more nuanced because the stock market changes depending on how you approach it and what you invest in and for how long you invest in it. And that this is why we invest in market indexes long term. We also enjoy dabbling in some stock picking. We'll get to that. But this is why the core of our portfolio are these long-term indexes because these numbers just keep bearing it out.